Every day, billions of dollars exchange hands as investors and traders buy and sell stock on market exchanges throughout the world. In fact, according to USAFacts.org, more Americans than ever are invested in the stock market. Data from the Federal Reserve's Survey of Consumer Finances shows that 53% of all U.S. families own publicly traded stock in some form in 2019. That number is up from the 32% of families that owned stock in 1989. Add to that, the median stock value held among U.S. households in the market was $40,000. With such high interest in the stock market, with trillions of dollars invested and billions of dollars being exchanged each day, we decided to answer the question, what exactly is a stock? To finance their daily operations or to finance their planned growth, companies can raise money by offering ownership of their company to the general public. The process in which companies offer ownership in exchange for money is called an initial public offering, also known by the acronym IPO. During an IPO, companies issue stock in exchange for money. Stock, also known as equity, is a term used to represent ownership in a corporation. When companies sell stock, they are selling investors fractional ownership interest in their company and essentially making them part owners. As an owner of the company, you may be entitled to certain rights. For example, in some instances, owners are given the right to elect company leadership or vote on important issues that the company may face. Similar to a way that liquid can be measured in ounces or gallons, or to the way that food can be measured in pounds or grams, stock ownership also has a unit of measurement. That unit of measurement is called a share. A share represents a single unit of ownership in a company. When you look at the price information for a stock in your brokerage account, the price that you see is the price per share, also known as the share price. That price can fluctuate depending on what investors are willing to pay for the stock. When you own stock in a company, you are called a shareholder. As a shareholder, you are entitled to share in the profits if the company is profitable. Those profits are paid in the form of dividends. Dividends are when a company pays a portion of its net profits to its owners. Dividends can be paid out monthly, quarterly, or semi-annually. However, most are paid quarterly. There are two types of stock, common stock and preferred stock. Each stock has its own type of features and benefits as well as risk. Here are some of the features, benefits, and risk of both common and preferred stock. Common stock is the most widely offered stock type. Common stockholders are guaranteed the right to vote on important company issues and the right to vote for election of the company's leaders. They also have the right to receive dividends if the company is profitable. Even though common stockholders have certain rights, those rights are sometimes secondary to the rights of preferred stockholders. For example, common stockholders receive their dividends after the company's loan payments have been paid and after preferred stockholders have received their dividends. Also, if the company happens to go bankrupt, common stockholders are last on the list to be compensated from liquidation. Preferred stock is not as widely accessible as common stock and is typically reserved for early investors. Preferred stock is given preference in dividend payout and receives a fixed dividend payment. A fixed dividend means that shareholders who own preferred stock receive dividend payments regardless of the company's profitability, whereas common stock owners only receive dividends if the company is profitable. Preferred shareholders also receive preferential treatment if the company has to liquidate. This means that if the company is forced to cease its operations and sell its assets to pay debts and investors, preferred shareholders will get paid before common stockholders. Unlike common shareholders, though, preferred shareholders do not have voting rights, and therefore they cannot vote on company affairs or leadership roles. In short, Stocks represent ownership in a company. The amount of stock that an investor owns can be measured in shares. There are two types of stocks: preferred and common. Common stocks have voting rights and receive a dividend if the company is profitable. Preferred stocks receive a fixed dividend and receive preferential treatment for dividends and in the case of liquidation. Thank you once again for watching, and if you find this information helpful, please click the like button and subscribe for more videos about the stock market and options trading education.